They say we should have known better than to fall so deep down into this rabbit hole we found. And I was thinking.
Hi, this is Nikolai, and you're listening to my dad, Rafal, co-host James Jardine, and featuring Mr. Jim Tiller on the one and only Down the Security Rabbit Hole podcast. Plug in, listen up, and enjoy.
Deep into this pool of regrettable situations, pitch black, think back to the last time that we were happy.
Hello, good morning, good afternoon, and good evening. Welcome down to Security Rabbit Hole to another edition of your favorite cybersecurity podcast, the Down the Security Rabbit Hole podcast. This is Raph. I've got James over here, and that way is Jim, and that guy right there, that guy. Returning guest, Patrick Dennis. How are you, Patrick?
Doing good. It's good to see everybody. Thanks for having me back. So far, I've remained employed. Raph has always invited me in an attempt to get me fired. So far, I've been successfully. Although I feel like we're going to go into the topics that might make me unemployable again. So thanks again, Raph, for the invitation. It's really nice.
Yeah,
what a good friend.
My pleasure. Listen, I had a whole bunch of these conversations at Black Hat about getting funded and VCs and PEs and valuations and stuff. And I've always been like interested and followed all this, but I think this whole thing started with, I saw a bunch of these announcements at Black Hat, and I've always wondered, like, you're on your, Series D funding round and you're super excited about the next 50 million you've taken on. And I've always wondered, like, that feels like you're celebrating the wrong thing. And so naturally I go to the person that lives and breathes this stuff. And then you wrote a blog post and an article, and I said, hey, let's go do a 2-parter on the podcast and just talk through this and like a one-on-one for people that are curious. And so Professor Dennis, welcome to the show.
Well,
I feel like I should get you a jacket with like the patches on the elbows.
Well, I did. I almost played a joke on you guys, and I have one time I went to a disco party and I have a cheetah jumpsuit, and I felt like, given the fact we were going to dive down the venture money rabbit hole, it was maybe necessitated the cheetah jumpsuit. But today
I will be Patrick, I will be offended if you don't do that for part 2 of this episode.
Okay, so for part 2, the cheetah jumpsuit's in.
Oh my God!
You guys heard it here, people.
This is now a must watch for part 2. All right, listen, I'm gonna. People know who you are. If not, give them a quick taste.
Yeah, my name's Patrick Dennis. Been lucky enough to be a CEO a few times now. Mainly do cybersecurity and some comm software. A lot of times, if you're a CEO and you do something in one segment, you can't go back to it right away. So you have to sort of have 2 domains. I think I got brought on today. I exited guidance software to OpenText. I exited Venafi to CyberArk. I concurrently bought and sold Aspect Software and Noble Systems and made a company called Alvaria with about a $1.3 billion raise. Been the chairman of the board of a company called Ripcord for the last 8 years. That's backed by Google, Kleiner, Lux, and Icon. And so, so I sort of swim in these waters. And so I think, Raph, what you wanted to do was try to demystify some of the space for the audience. And since you guys have been nice enough to demystify things for me over the years, I will try to return the favor as best I can. Although if there was any water murkier than cyber, it may be finance. So
that's why we're talking. This is why we're talking. I feel like this is going to be, for me, I'm glad we're recording this because I'm probably going to listen to this a couple of times. I feel like I need to absorb this. Sometimes you got to listen to it twice, 3 times to actually absorb something. So let me start this. How to explain to us, because there's private equity, venture capital, some other things in there. Talk to me how these how and why people go, just kind of on the surface, right? And then we'll dive in. Why people go to get funded at different stages.
Yeah. Well, So I guess let's start at the beginning. If we all start a business, let's just use the four of us. If we start a business today and we had a product and let's say we wanted to go sell it, right? And maybe, Raf, you are the service person, and maybe James is the product person, and Jim does the back office, and I run sales. Probably by Wednesday of that week, if the product is any good, we're all going to look at each other and say we need to hire another person. And so, the real reason people go get funding is they draw the conclusion they can't scale the business as quickly as they want to with their own resources. That's particularly true if it's a founder's first time doing something. Very rarely do they have enough money to go sometimes you will hear self-fund. And so if you can't self-fund it, you wind up having to go off and take out some money so that you can go try to scale the business. I don't think of it as being that dissimilar. Most finance equivalency I can kind of draw to your personal life. If your company is a big investment as an individual, that's sort of like you going to get your mortgage. Most of us can't afford to buy the house that we want out of the gate. And so we can put together some money for a down payment. We need to go take some money out for us to actually buy the home, and then we're going to pay that money back over time. So, I guess before we get into the dark art of all this, we should explain, why does it exist in the first place? It's very difficult to compete and scale a business on the back of your own resources if you're a founder, even if you're co-founders. And so oftentimes you need to go get money, and your upfront choices are really, do you want to go raise debt? Most people don't have a business that can raise debt. We can talk about that if it's interesting out of the gate. So they go and they try to find somebody that is as interested in the business as they are and believes in the business. And that's how they, quote, get funded. That's sort of how it all begins.
Okay. So I've heard terms angel investors, seed funds, institutional venture capital. Then there's private equity further down the line. What's the difference between those? And when should you be hearing or using each of these things?
Yeah. So they sort of loosely tie to when you hear people talk about rounds of funding. So sometimes you'll hear about a series A or a B or a C. These days, in the old days, you didn't really go much beyond C and D. These days, there's E, F, G, H, I, J, right? Whatever. So think of each of those people as having a type of expertise. So angel investors I'm going to way oversimplify. So listen, somebody in the comments is going to hate me for whatever I say today. So I get it, haters. All right. We're going to try to keep this at a cursory level for everybody. You want to come at me in the DMs, come at me. All right.
Oh boy.
So let's go with the easy one. So angel investors generally make smaller bets on very speculative companies. So you could think of that as, again, it would be sort of the four of us start a company sort of phase. We sort of have a product. Maybe we don't even have it ready to quite ship yet. We probably are pre-revenue. We might not have a customer. That's sort of when you're like, okay, but we need some funding. You're looking for an angel investor to come in and make a really early investment in a company. That could be a check that's as small as $25,000, $50,000, $75,000. It might be a check that's $200,000, $250,000. So relatively small amounts of money. Typically, the reason they do it is they wind up with reasonable percentage of the company in exchange for that. You also tend to see in angel rounds, you'll sometimes hear people say it's a friends and family round. It's not unusual for the angel round to be done by people that are in the circle of the founder or founders versus professional, what I will call, in air quotes, professional firm-based investors. Right. So that's sort of the angel round. After that, you're probably headed into venture. And I'm going to, again, oversimplify. If I named all the venture firms I know, some of them are sort of invest in bigger things, some of them in smaller things. So there's diversity inside of venture. But broadly speaking, venture sort of comes next. They're going to write a slightly bigger check depending on the series that they're coming in. And most of them sort of focus in certain series. So you'll find some venture firms primarily do A rounds or B rounds, right? Typically, the asset is a little less speculative. By now, there's a product, and they probably are thinking about how are we going to take it to market? Those people get involved because they're writing checks that are going to return, if things work out, really big outcomes. So typically, I know this has been on your mind, those are the kind of people that go in understanding they're going to make, quite literally 100 bets and maybe one or two are going to work. After venture, you get into a round typically called growth. Those growth rounds, sometimes growth equity comes from venture-backed firms. Sometimes it comes from private equity-backed firms. If we went and we looked at all the firms, inside of them, they have different disciplines. So I'm just going to call that growth equity, although very few firms call themselves growth equity firms. That's typically where the fund comes from after venture. And by that time, somebody's had product market fit. They're looking to scale it. A lot of that funding tends to go to market and tends to come when people think that they can actually scale the business. And then once we get past those phases, we can talk about sort of like what comes next. But typically success is sort of the fork in the road after that. So angel invest, we kind of bootstrap a company. All right. It has some relative success. We get some venture people interested in it. We go off, we prove product market fit. We get a few customers. Now we actually need to scale the business more quickly with, perhaps salespeople and go to market. We're going to go get some growth equity that probably comes from either the venture community or a growth equity fund inside of private equity. That's sort of the beginning.
Where does like Shark Tank fit into that? Because I'm sure a lot of people know what Shark Tank is. Like, is that like venture, or is that because those people sometimes have something, sometimes don't?
That's sort of a funny thing. So like that show in and of itself is not representative of either of those two camps. They really are more like what you would expect somebody to do for an angel round. Typically when you hear those pitches, those folks are going there saying like, hey, we have an idea, but we need some capital to get it going. And oftentimes, when you watch that show, listen, I watch Shark Tank when I'm on the road and it's 2:00 in the morning and I can't quite get to bed yet. And I turn on CNBC because it's always channel 16 in a Marriott. All right. That's usually the show that's on. Most of those people haven't had some wild success. And so they need some money to get started. So it's a good example for that reason. So I would think of them as, a little bit more like angel, although in that show's case, there's some really smart people there. So they're bringing some skills to the table. Usually in angel investing, you don't necessarily get skills. By the time you get to venture, it's a firm. So you're going to get somebody that's making an investment in the company, but they probably also can bring you some skills and experience that maybe you don't have yourself or the management team doesn't have.
So often in like angel, you're not getting the expertise. Like they show like, oh, I've got all these connections into this. I can get you into retail. I can get you into that. Yeah. Angel's probably not getting that. It's like, hey, I know somebody that is interested in this and they're willing to pony up some stuff.
Probably not. Like, for instance, I know a few people that would call themselves angel investors who have worked in big tech. They have made, call it tens of millions of dollars in their careers. They're willing to put some of that at risk in something that's an alternative to the stock market or whatever they do. They're not necessarily super professional. That's kind of the entry level part of angel. There are some sophisticated angel investors as well. But, you get the full gamut. You get some people that are sort of like playing around with what they think is house money in their personal lives. And you get some people that are professional. Typically, they're not bringing a firm to bear that has a ton of skills, though, which differs a lot when you get to venture. When you get to venture, and certainly when you get to private equity, those people are going to bring experts to the table to help scale a company.
So the thing that I've always been interested in is you go from, I have an idea, I've got a minimally viable product. Like my buddy and I built this in the basement. I think it's going to work. I tried it in a demo. It's running on my laptop. All right, but I need to go buy a bunch of computer. I need to go buy a bunch of stuff. And I don't have the cash for it, right? You go angel, you build the thing. You go, all right, I can talk to a CISO friend. They're willing to try it. They're like, oh, cool, this is going to work. We tried it. Now you're like, okay, now I need actual money to go like hire people to professionally build this thing. How the hell do you know how much money to ask for and how much of your business to give away, right? Because that's the trade-off is you get money and in exchange you give away future profit, right? Or future revenue in the business.
Yeah. Well, I mean, what you're really giving away is ownership. So this is really an important.
That sounds
this
worse.
Is actually this. It is worse. This is and this is sort of the important point. One thing that doesn't equate in my mortgage example is, let's just say you want to go buy a boat and people take out home equity line of credit to go buy a boat, something like that, right? Well, what the banker doesn't do is show up and sort of sit down in your home office and occupy it, right? Like, you didn't give away a portion of your house to get the home equity line of credit. When you go into these phases, what you really are doing is you're selling a percentage of your business for the cash that's going to come in the door, with the belief that you're going to go use that cash to make your business worth even more money. And therefore, let's just say you gave away 20% of the company. The money that you got is going to vastly improve the quality of the company, and therefore you're going to make it worth more than the 20% that you just gave away. So yeah, it's very expensive. By now, if folks haven't read the little bit that I wrote for you on venture, that explains this markup culture thing that I talked about a little bit, where there's this weird incentive system where, for a venture capital fund, a big mark, a big print, a big valuation has some reasons why it's really attractive to them. And on the founder side, what typically happens is, if you get a really big valuation, you're actually giving away a smaller portion of your company for the same amount of money. And so if you didn't know anything, you'd go, well, why wouldn't you do that? Well,
yeah, there's a but in this, isn't there?
Well, there is, because what you're really signing up for is you're loosely guaranteeing the future performance of the company. And so, it's the same reason why you are thoughtful when you go out and you take a mortgage. You think about what you're earning today. Maybe you buy up the house a little bit. We've all been through the phase where, you have kids and stuff, and you're looking at somebody and saying, we need a bigger house. You might have to buy something that's a little beyond your means those days, but you're going to work harder and you're going to do better. Right.
Right.
That said, I don't think you show up at the bank earlier in your career on the cusp of having children and say, well, I'm going to go buy a $5 million house. Right. So you have to use some good judgment, because ultimately having a really, really high valuation and then just burning those dollars only puts you in a really difficult spot later. And, we've seen that happens time and time again, and it creates a bunch of problems structurally in getting another round of funding. And I'm happy to explain why, but in most basic terms, once a valuation gets set, very rarely do people want it to come down. So if somebody puts an amount of money in at $1 billion valuation, you almost need the next amount of money to come in at $1.5 billion or $2 billion. It's very hard to do what in the industry is called a down round, which would be you're taking more money into the business, but the valuation's coming down. And you're seeing that now, because so many people raised so much money on these crazy valuations that they're not exiting the companies at those values. And now they still need more money to run the business. Nobody's going to put money into the business at those high valuations. And that's what's causing the pressure in the system, that I think is probably causing this discussion right now. You and I could have had this discussion 2 years ago, 3 years ago, 4 years ago. We're having it now because the pressure in the system is starting to show up because of these large valuations and the fact companies haven't exited for that amount of money.
So we've said you've used valuation a couple of times, right? Tell me, explain in really high level and go one layer below. What is a valuation? What does that actually mean?
So again, let's use the house example. Who moved into their house the longest ago? Has anybody been in their house 10 years? 5 years?
Something like 10 years.
20. Okay. So my guess is the house is probably worth more now than it was when you bought it, right? So the valuation, Raf, would be if we had guessed what that house value is going to be 10 years in the future, okay, that would have been the valuation. We would have said, we expect it to be worth, X number of dollars. Right now, none of us do.
How far do you go? But how far in the future do you go? Is it a year? Is it 5 years? Or is it at some point?
That's a really good question. The answer can be a little complicated. So I'm going to make this is definitely going to get me hate in the comments. Really, when they think it's going to exit. Okay. That's the real answer. Okay. And the reason I say that is because in order for any of what we just talked about to turn into real money, you have to exit a company and then somebody's got to write you a check. Okay. So the valuation is all on paper until somebody buys it.
Got it.
And so the answer to your question varies a little bit based upon where the company is in its life and when specifically the investor and or the founders and or the management team think they're going to exit the company.
Gotcha.
Does that make sense?
Yeah. Okay. So at the time of the whatever the next event, right? The sale or the next transition point.
That's right. Now I will answer your question more generically. For most people, that answer is something like 5 years. Okay. Plus or minus 2. Most things are somewhere between like 3, 5, and 7 years is sort of when an event has to happen.
Is that due to how long people actually think it's going to take to get there, or people don't want to wait that long to cash out?
All right. Definitely going into the dark art now. You're going to hate this answer. And I hate this answer. All right. So we're now going to push pause on the company for a second. We're going to go run an investment firm. All right. So if we ran an investment firm, what we would do is we would raise the money that eventually I am going to give to you guys. All right. For the company we just talked about. So let's just pretend I raised $500 million to pick a number. All right. Well, the way an investment firm would talk to people about getting that $500 million is, hey, all you rich people that are going to contribute money to my fund, if you make a $500 million investment, I'm going to return 2 to 3 times your money. Okay. Now, that might sound great. What is the natural question for that person to ask? It's a W question. When? Right? So, the answer, James, to your question is, in these funds, most of them exist for 5 years to 7 years. And you have to start to show first of all, when you raise a fund, you have to go deploy it. So you have to find stuff to go invest in. Then ultimately you have to go get the money back from these companies that you invested. And most of your investors don't want to wait forever and a day. So that 5 to 7 year window tends to be a pretty important window.
Okay. Like putting your money into a CD, it feels like a little bit here, right? Just much riskier, right?
Well, yes, but it also probably is going to give you way more money in return. Yeah. Right. And that's that's how you get into this game. Right. So the reality is, if we all went off, and this is sort of a weird time in the world, which we're not going to dive down this today because it's too complicated. But the reality is, for most of the time that we've been working, if you put basic money into these very basic things, CDs, bonds, like you left it in your checking account, you're going to earn 2-3%, something like that, 4% maybe. So the notion of doubling your money certainly wasn't going to happen. You needed to go find something else to do that. Now, at some stage, if you have enough money, you could say, okay, well, I've got enough money to be comfortable. In order for me to do something great, I'd actually have to double this. So, if you think about the range of ways people invest, very wealthy people typically are willing to take on some additional risk because honestly, they need more absolute dollars for it to make a dent in their life. So, yeah, you're right. The hold periods are longer. So a couple parameters here kind of describe the kind of people that invest in these things. They need to have enough money that they don't need that cash right away, right? Because you're going to give it to me and then I'm going to give it to you guys and you're going to go build a company. And then 2, you sort of have to have enough money that, the money has to sort of double or triple or it's not really going to make a dent in the broader scheme of things. Does that make sense?
Yeah. So big piles of cash.
I was going to ask you a question about like this sort of after the first round and getting the second and third rounds, right? Now let's assume the valuation goes up. Is there a point where, so I assume, let's say we have our company now, we've given you 50% because you gave us a bunch of money, right?
Yep.
We valued it at $1 million. So you gave us, $500,000, and the math works out. Now we need more money. You're not willing to dump in more, right? Let's say you're the angel, okay? But we need more money. But now the company's valued at, say, $2 million. So effectively, your $500,000 became $1 million from a valuation, right? Now we have $1 million. Now we go generate more funds. So we go to a second sort of round or first round outside of angel. We only have an option now of using our half to sell it, unless you agree to give up some of yours. So we're continuing to dilute our ownership at that point, aren't we?
Let's pick up on your D word. That's a really important word. And you just sort of walked everybody through something that's important. What Jim just described is the process of dilution. And what that means in plain English is if your ownership percentage in a company is 100% on the first day, and over time you're taking these rounds, the portion of that company that is owned by several different people, the number of people tends to go up. You'll hear that described as the cap table getting big. Right. And typically every individual that's in the cap table is getting diluted. Now, this is one asterisk that I do think is worth mentioning. We're not going to go down this path too far other than to say, Jim, there's a notion of people going in what's called pro rata, which allows them to maintain a percentage over time. So there's mechanics to get through those things, but principally you're correct. Over time, what you're doing is you're diluting your percentage.
Is that diluting all percentages though? Like if you're the initial 20% to get it going, we go to round 2, we sell another 20%. Is that coming out of the owner, or does the person they put in the initial 20%, are they getting diluted as well?
They'll get diluted unless they put in more money.
But the idea though is your lesser percentage equates to technically more because the valuation of the company presumably has gone up.
And that's why everybody wants the values to go up.
Okay. And then how does that...
Does that make sense? Does that make sense why?
Yeah.
Yeah.
Okay.
Yeah.
Because if you just use really easy math. Okay. If you raised $20 million, means I'm going to give you guys $20 million, right? At a $200 million valuation, that means you give up 10% of the company. At a $100 million valuation, that same $20 million that you're getting in the company is worth 20% of the company, right? So that is part of why there's this wicked incentive system that says you want to ratchet up, these values. Okay, so this is a really good time to make this point. What is the principal problem with that vis-a-vis what James brought up a minute ago? I have to be able to sell it at that value.
Yeah.
Right. So where I start to think it gets pretty cringy is when you start to see these valuations that are really big. And then I'm going to again try to oversimplify this for everybody. I'm sure all of us started off in starter homes, and, there's been some lucky people here. It gets a little harder to sell these houses to people because there's fewer people that can pay for nicer houses. Right.
Yep.
Which, great example is how many times do you see movie stars or athletes when they finally sell their mansion in Florida, for $45 million, and there's like one buyer, right? It's hard to sell a $45 million house that a basketball guy had, right?
Yeah.
So what's tricky is these valuations get ratcheted. Well, you get to a place where you have to say to yourself, like, okay, Jim, who's going to buy it? Right. And that, I think, is the part that not a lot of people think about, but is really, really important. So as the values start to climb, and James's point, you need to sell it. You have to ask yourself a real question, like, who can I sell it to for this amount of money? And now in cyber, let's pick some easy examples. If you want to sell a company for $2, $3, $4, $5 billion, who can you sell a company to for $5 billion these days?
Cisco,
Google.
Microsoft.
Okay. We're at 4 so far.
Probably a couple more, but that number gets really small real fast.
It gets thin, right? And by the way, how many times have you guys heard people, when you're at these conferences, throw around $5 billion valuations like it's not a big deal?
All the time.
All the time. I'll tell you, like,
especially
there's a bunch.
Recently.
Yeah, recently, right? And so, yeah, I get it. Everybody can pull out the example of Wiz. How many Wizes have we had in the last 5 years?
Ooh.
I can name one. Wiz.
One, right? So that's sort of, let's back up. So we started a company. We needed money to scale the company. We didn't want to dilute ourselves. So we took a really high valuation to get the very amount of money that we needed. We can come back to why we figured out how we never really answered that question, how we figured out what money we needed. But we took this really high valuation. Then we burned, another key word that you guys hear. We burned. Yeah. We didn't make as much money as we were spending. So we burned the money that got invested. Now we need to go get another round. So we got another big valuation for that amount of money. Now all of a sudden James is on our doorstep and he's like, hey guys, I need some, magic word, liquidity, which means I need to sell. All right. And we're all looking at each other going, okay, where do we sell this $3 billion company? And we have a list of 4. Does that make sense? How this gets sticky quick?
Yeah. So let's touch on that one, because I have a feeling this is gonna be another one of those ugly things. Is like, how do you figure out how much you need? Like, because I think the naive perception is, let's go like, oh man, I'm gonna go raise $50 million. That's gonna make me rich. It's like, no, that's not the part that makes you wealthy, right? That's not the part that earns you money. That's just debt.
Yeah, it's just, you're just taking money for a promise in the future that you're going to give that money back at a multiple, right? So maybe this is a good time to just introduce this idea. Raph, you and I have worked together before, so you have seen me do this, and you've seen that it's occasionally not popular. Probably vis-a-vis the people in cyber, I'm one of those guys that's pretty thrifty when it comes to spending. And, I've taken some heat about that before in companies that I've worked for, like, why is he so cheap? And the answer is because I sort of assume every dollar that we spend, if we're in air quotes burning, okay, needs to get me like $5 or $10 back, or ultimately I'm not doing my job for you guys in this example, right? And so when somebody's like, hey, I want to have the sales guys go on a club trip to, wherever, Tulum, and it's the single most expensive place in the whole world. I'm like, okay, well, could we do the club trip in Montana? All right. If we were going to go to, pick your favorite, well, we're not going to pick on RSA, but we'll pick your favorite conference. Pick your favorite conference. They're all expensive. A lot of those booths, just the booth, are a couple $100,000. Maybe the entry point
dollars is what I heard this year for the big one. Like, are you kidding me?
I mean, we used to pay, you've worked at companies with me where we've paid $250,000 for a booth.
Yeah.
Right. So you start to ask yourself, like, do I need the $250,000 booth? Do I need to be at this conference? Do I need to be at all the conferences? Okay. How many salespeople do I need? Do I need 100 or do I need 10? Do they all need SEs? Do I need a 1-to-1 ratio, or can it, they're all the right questions to ask. And so what I would just tell you is, like, as an industry, this industry almost never calculates what it actually needs. This industry, because raising money has been so easy, has not been particularly good at raising the amount of money that you need to spend it on the stuff that you need.
Yeah.
This industry is sort of a raise blindly and assume there's another raise kind of industry.
So this is the conversation we had a while back, and that is, I think we had on a different podcast actually. Like, there was a time when raising money was easy, right? It was money was cheap, interest rates were low. Like you could get a bunch of money for a smaller percentage of the company. Valuations were all exorbitant. And then money got expensive. And like, it feels like all of these companies right around that time needed to go get more money because they were burning like crazy because money was cheap. And then suddenly you're like this huge value, your $2 billion valuation, you're about to run and miss payroll. And you're like, hey, I'd like a $3 billion valuation to raise money. And somebody looks at you and goes, yeah, you're like a $750 million company. And then what?
Yep. Yeah, that's 100% right. So that period of time that you're referring to, you often on prior times you've had me on, you've heard me refer to that as ZIRP, the zero interest rate policy, which we had in place for a long time. And again, I'm going to oversimplify this, but if money costs you zero, okay, and I go hire a salesperson and they sell even one thing, okay, and it's actually worth just the same amount of money that we took out to hire the salesperson, we're even. If they happen to sell two things, okay, we're better off. So when the money is free, you actually, as long as you have some growth, okay, it almost didn't make any sense not to keep trying to grow, right? Yeah. Then when the money gets really expensive, the question is, and it brings up a few, one of them is, was the business model that you just built efficient enough for you to continue to grow without that level of spend? And that's what really broke down in cyber. Most of these businesses couldn't achieve 20, 30, 40% growth rates efficiently. And that's when you saw, like recently industries had a little bit of a hard time there. And I think people sometimes are trying to figure out why. That has a lot to do with the why.
Yeah. I think that efficiency, right? Because it was, the evidence was in the booth sizes. The evidence was in like how much money they're spending on, private concerts for random strangers or for potential customers, or, race car things and sponsorships and all kinds of crazy things. And suddenly, but there's different stages of business. Like, I think at the beginning, you're just trying to make sure that you have something that works, and then you got to get the name out. You got to get people to notice that you're there.
Yep. That's right.
But at some point, I feel like a lot of companies that, and maybe I'm wrong, Patrick, correct me here, but I think that's where a lot of companies got stuck. They never got to that, okay, people know us. Now we need to get serious about what we're doing. Because that burn rate, when you're trying to quote, get the name out, it is often very, very crazy high. But at some point, you're like, all right, the market knows us. Now it's time to go sell. And that's a different level of spending. Right.
It is. So if we kind of go back, we've touched on this. You're now entering you're sort of entering C and D round funding now, just to kind of try to tie this back for everybody. So if we kind of go all the way back, we got angels that get us started. Okay. Sometimes you'll hear that called seed stage, by the way. I don't think I said that earlier. I probably should have. All right. Then you get to A. A funding is usually sort of validating product market fit. That's sort of what is happening right then. You start to scale a business model. B is typically where you're growing the team and you're trying to actually acquire some more customers, usually bigger customers. So that's sort of like an expansion round. Now you're talking about C and sort of beyond. Once you start to go into C, people start to talk about like aggressive scale, hyper growth, international expansion. We're going to do acquisitions. Typically is also when you hear people say like we're pre-IPO. Yeah. Okay. All right. So let's maybe just spend 10 seconds on that because I think it's a good time to make this point. So back to, we raised a bunch of money and we found 4 places to exit the company, right? Because it was worth $3 to $5 billion. All right. What option did we not throw out there that could raise $3 to $5 billion? We could go public.
Yeah.
Right. So also in the cards in these phases is somebody considering going public. So typically if we've kind of gone angel, pre-seed angel, A, B, C, D, valuations up, right? Now we're like, okay, we got to go again to James's earlier thing. We got to find liquidity. Okay. We want to go sell the business. Okay. There's 4 buyers. Nobody's going to buy it. The next thing you start to hear people talk about is, hey, we're pre-IPO, because that's the other way you could picture creating enough value to sort of pay the investors and the employees. Does that make sense how that creeps into the conversation?
Yeah.
It is a whole nother conversation though.
I've been a part of companies that have been pre-IPO for like years.
Yeah. Well, I mean, you got to keep the plate. Like my joke is, in the old days, actually Jim and I might be the only two old enough for this. Do you remember like when they used to spin the plates at the circus gym and you didn't want the plates to fall? I mean, you got to keep the plates spinning. So if the company's not going to have an exit, and you got, difficult guy like James on your doorstep saying, I want liquidity, what do you have to say to him? You got to say, don't worry, James, your investment's okay. This thing's pre-IPO. We're going to get IPO'd. You're going to get your money back. So, you need a story. So it makes sense why people do that.
So one more thing before we say, this segment's done, and then we'll come back for part 2 in the next episode. But sure. I want to talk about, because we're talking about giving up control of the company, right? I want to dive a little bit more into that, because it's not just in your example, like the investor gets to take a room in your house, but the investor also gets to tell you, like, if you're going to go take that money out for a boat, they get to go shopping with you, right? They get a say in which boat you buy. They get to say in how high you turn up your heat in the winter and your AC up in the summer.
Yep. No, that's right. So now it's interesting. So if you've ever been through these processes, at some stage, the person that you are talking to about raising the money is going to talk about how hands-on they are.
Yeah.
And some people say, hey, listen, we're hands-off, and they mean it. Some people say they're hands-on, and they mean it. In my experience, everybody is hands-on when something's going wrong. So, no matter what gets said to you up front, there's no such thing as passive money when things are off the rails. Okay. Now, you can get left alone, all right, if things are going really, really well. But, that doesn't mean, and I think people have like the wrong view of this. If you're going to take somebody's money in a private company context, it's no different than a public company, in the sense that in a public company, you owe reporting to the shareholders in the street and all that sort of stuff. You actually owe your private investors the same thing. So yes, you're giving up control. The distinction that I think is important is, when I ran a public company, I had a bunch of shareholders. There were like maybe 3 or 5 that had big positions, but it was still 3 or 5. Most of the time what we're talking about here, there's 1 or 2, venture capital firms or private equity firms involved in a deal. So you really have like 1 shareholder. And so the amount of influence that they can exert can be quite high, right? Yeah. So, oftentimes those things are described a little bit more like a marriage. And I think that's probably true, because you both got into it together, and, they're going to want to have an opinion. They're going to have an opinion, and they're going to want you to take it seriously. That tends to be the place where founder friction starts to show up first.
But that's why picking, that you go into business with and who you still part of your company with, is you want to make sure you have great connections, that your vision
1,000%
in many ways is shared. Because we're saying it in almost, I won't say a negative way, but like you said earlier, bringing skills to the company, it may seem like them blocking or getting in the way or showing up and, looking through your stuff. They may be helping to find you opportunities to build efficiencies, go to market faster, get rid of some waste that you've collected.
That's true. Somebody in the comments, when I posted the one article, brought up, the right venture capital firm can bring credibility to your company. And at Ripcord, when we did, Google, Kleiner, Lux, Icon, those are like real firms. They'll bring some credibility to your company. And, so like a lot of times this industry does get a bad rap, and I get it. Finance people do a lot of silly things that earn them the bad rap. But the reality is a bunch of these companies wouldn't exist without the backing of venture capital and the investment that people made. And there's a lot of great people that are in these places. And so maybe the way to like take Jim's point and make it hyper actionable is like, if you're in a decision-making capacity on these kind of topics, I would worry less about the firm that you're working with, and I would worry more about the person at the firm that you're working with. Like if that person believes in what you're doing and does have a shared vision, all the things Jim just said, it's a great list. Like, you want to work with that person. They happen to be at a firm. I do think sometimes people get a little too focused on the name on the outside of the building, when the reality is your experience with, any of those places I just listed is going to be because you deal with Raf at Kleiner, or, you deal with Jim at Icon or whatever. And you want to make sure the partner that you pick is somebody that you can work with as best you can.
That's a good place to end it, because this conversation is just getting rolling. Come back for the next one. On the next episode, we'll talk about what happens down the road, what happens when you miss that that exit window and all the fun stuff. Because we're all about touching that third rail, right, Patrick?
I'm feeling this one was good and educational and like pretty tame, because so far in this conversation, everything has gone for the most part well. I sort of feel like in part 2, we have to do the part of like, you know, when reality hits, what happens next?
when that what's that gif of the reporter that's standing there? A huge wave comes by and the giant mackerel just slaps her across the face.
Yeah, and or the one where you want to be Homer that's fading into the bush, right?
Yes, that one. Homer fading into the bushes. All right, guys, come back for the next episode. Patrick, thank you so much for doing this. We're gonna give it some thought. We're gonna come back for part 2. Jim, James, awesome having you guys on board. And this is obviously the conversation, you know, to ask questions and less the hate mail, but, you know, questions, concerns, comments. Yeah. This will go up on LinkedIn in the Down the Security Rabbit Hole podcast group. And I'm sure Patrick will have a link to it as well, and everybody else. So let's ask the questions that are on your mind. What did we forget? What did we not talk about? Where do you want to take this with? And then we'll take some of that and have the next conversation. We'll see you guys another time, another place on another Down the Security Rabbit Hole podcast for part 2 of this thing. We'll see you in a bit. Bye-bye.
This is Bella. Thanks for listening. Don't forget to leave my dad a review and share this with your friends. Bye.